Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into the Wall Street Journal from August 8th, 2025. We'll be looking at key developments in global trade, U.S. policy, and corporate innovation, really distilling what you need to know.
Exactly. And what's interesting is how interconnected these areas are. We'll try to, connect those dots. So let's start unpacking the main findings.
Okay, sounds good. Let's kick off with global trade. Tariffs are still a major story. The Journal is reporting nearly $12 billion in losses for global automakers because of President Trump's tariff policies.
That's right. And Toyota, for example, they're forecasting a huge $9.5 billion hit through next March. They're projecting something like a 44% drop in net profit. That's significant.
Huge. And it seems to be forcing some difficult decisions. GM, for instance, they plan to import batteries from China's CATL for the Chevy Bolt EV, even with an 80% tariff.
Right, because the U.S. manufacturing side just isn't ready yet. It really underscores the operational bind these companies are in.
It's not only the auto sector, is it?
No, not at all. You've got Ralph Lauren, Caterpillar, Crocs. They're all citing tariff pressures. Crocs is looking at maybe a $90 million annual hit.
Yet on the flip side, Apple secured a 100% exemption on chip tariffs. How?
Well, they pledged $100 billion in U.S. manufacturing investment. It shows how leverage works, really. Companies with that kind of scale and investment power can sometimes negotiate different outcomes. Others just absorb the cost.
And meanwhile, China's exports actually grew in July.
Yeah, interestingly, they seem to be offsetting some U.S. impact by boosting trade elsewhere, a definite sign of trade flows shifting.
Okay, let's pivot to U.S. policy. There's movement at the Federal Reserve. President Trump nominated Stephen Marin to the board. He's known as a critic of current Fed policy.
And an advocate for more White House control, which is certainly noteworthy for the Fed's independence. At the same time, there was that executive order expanding 401k access to private markets.
What does that mean in practice?
Essentially, it could allow everyday investors to put retirement funds into things like private equity or venture capital. These were usually just for institutional investors. It's something Wall Street private equity firms have wanted for a long time, unlocks a lot of capital.
But while that door opens, another seems to close. The EPA terminated a big grant program.
Yeah, a $7 billion program for residential solar aimed at lower-income households. So a definite shift in federal funding priorities there.
Now let's talk tech. OpenAI launched GPT-5.
Right, their most advanced AI model yet. Sam Altman described using it as like talking to a PhD-level expert. Apparently, it can create software from what he called vibe coding, just describing the feel or function you want.
Vibe coding. And the valuation talk is already around $500 billion.
That's the number floating around. Shows a month's investor confidence, even though they're still losing money.
But it's not all smooth sailing in tech. Intel's shares dipped.
Yes, after President Trump called for the CEO's resignation over past ties to China, it highlights the increasing political pressure on tech leadership.
Quite a contrast to Firefly Aerospace.
Yeah.
Their shares jumped after their IPO.
A 34% surge on their NASDAQ debut, yeah. They raised $868 million, helped by that successful moon landing earlier this year. So very different trajectories there.
And connecting this broader picture, the Bank of England just cut rates again.
Fifth time in a year, down to 4%. They're facing inflation and a cooling job market, challenges the Fed is also, wrestling with here.
And down on the ground level, look at New York City's e-bike speed limit.
Right, the 15-mile-per-hour limit. It's proving really hard to enforce. Many bikes don't have speedometers, no real registration system. It directly affects delivery workers who rely on speed.
It's that classic regulatory intent versus practical reality friction. Okay, let's try to pull some threads together. First question, what's the core economic impact of these U.S. trade policies, especially the tariffs?
Well, the most direct impact is significant profit erosion for global industries, like autos. It forces tough choices, absorb costs, pass them on, or undertake complex supply chain shifts. While it aims to boost domestic production, it imposes real financial burdens, and we're seeing global trade reroute around it.
Okay. Second point. How do these AI advancements and tech sector shifts reflect investment trends and regulatory pressures?
The huge valuation for OpenAI, despite losses, signals massive investor belief in AI's transformative power. It's where the money sees the future. But then you see the Intel situation, and it's clear there's growing political scrutiny and influence impacting tech leadership and strategy, especially concerning China.
And finally, beyond the markets, what are the tangible effects of these policy changes on everyday economic life?
Things like the expanded 401k access directly change investment options for individuals, potentially shifting retirement savings strategies. On the other hand, Terminating the solar grant program impacts access to renewable energy for some households. And the e-bike issue shows how regulations can clash with the realities of daily life and work, particularly in the gig economy. It highlights that tension between policy goals and practical impact.
So as you track these developments, it's crucial to see how global trade, domestic policy, and tech innovation are intertwined. They're not just shaping markets, they're actively reshaping societal structures and, ultimately, your own economic landscape. Keep watching these connections.